Hi, my name is Philip Nathan and welcome to another one of our tax webinars. This webinar is in a Q&A format, so please ask questions, use the Ask the Question feature. The sooner you ask a question, the better chance you have of getting it answered. We're recording the webinar and we will email you a link so you can watch it on our YouTube channel. There's also an option on the link to book a meeting with us if you want to discuss any of your tax obligations in more detail with us. As ever, I'm joined by David Bruton, who is a chartered tax advisor and heads up our tax and accounting team here in Nathan Trust. So, David, welcome.
Thanks, Philip.
I suppose RSUs and stock options is where we're at, and maybe a little brief explanation on just the difference between the RSUs and stock options and the tax treatment on them. And that should only take a couple of minutes, and then we'll jump into the questions. As again, there's a questions and answers option on the Q&A on the bottom of the screen. So get your questions in if you want them answered. So David, if you wanted to jump in there.
Sure. So I suppose they're stock options and RSUs. You could probably view them as two paths to get to the same end goal, where an employee ends up with shares in their employer as part of their remuneration package. So I suppose the main difference between the two in terms of the way they're structured is that the share options have an extra step, I suppose, is the way I'd explain it. So with the share options, you're granted the share options by your employee. There's normally conditions attached. That might be a period of time, or a period of time for your service, or the company going public, or whatever it might be. And at the end of that period, that vesting period, you're then entitled to exercise those options. So the conditions have been met. You're entitled to exercise them, and then you can either choose to exercise them or not, and most people will exercise them. So it's effectively 3 steps. You exercise them, and that's when you trigger a tax liability for share options. So RSUs are a little different in that it's kind of like a promise of shares in the company, and again, there can be conditions, there can be a vesting period, and once those conditions are met, the RSUs vest and you receive the shares. There's no option there. So I suppose that's the extra step with a share option scheme. You have the option to either take it up or not, whereas the other one, you just get them. So that's the difference in terms of their structure. There's a big difference too in terms of how they're taxed, and not so much the tax rates or anything like that, but rather how the system taxes it. So with RSUs, they're taxed through your payroll, so it's quite clean in that sense. Your employer deals with the tax, they pay it over to revenue, and you'll see it reflected in your pay slip for the month in which the vesting happens. With the share options, it's different. The onus is on the employee for the most part. So the employer does report share options to revenue, but the employee, within 30 days of exercising their share options, what they should be doing is filing a return with revenue. It's called an RTSO, and effectively what you're saying to revenue is, here's the details of my share options, here's how much I think I owe, and you're paying that over to revenue at that point. And then the following year, you have to file a full income tax return for the year in which you exercise your share options. So you have to file that with revenue as well in the following year.
And just on the tax that you pay, one of the questions we had was that on share options, the person's finding that they have to pay income tax of 52% on them. Is there any way, is that just it?
That's pretty much it, unless you've got someone who's in a scenario where they were partly resident for the year, partly not resident in Ireland, or had moved around at the behest of their employer as well. So maybe was working in Germany or Ireland, a mixture of the two. So for most people who are living and working in Ireland, it will be 52%. The only other scenario I could think of where it wouldn't be is if, for example, they vested in a year in which someone had no other income or something like that, that they'd taken a sabbatical, but they exercised their share option. So it's pretty much, you could take it, it's going to be 52%, I think, in 99% of cases.
So for the share options, it'll be 52% on vesting is when they essentially purchase the share options, correct? And then it'll be 33% on the CCT, on the profit they make from selling them. Or have I got that the wrong way around?
Correct. So with the share options, it's 52% once you exercise them. And that's 52% on the difference between the market value of the share option or the shares at the date of exercise versus what you paid for them, if anything. So in some cases, people will have to pay a little bit towards them. In other cases, people are paying nothing, but it's the market value of the shares when you exercise minus anything you contribute towards those shares. That's what you're paying your 52% on, and that's when you exercise them. And then let's say you subsequently sell those shares, it's 33% capital gains tax on the difference between what you ultimately sell them for and what the market value of the shares was when you received them, when you exercised them.
Okay, and the timings on this. So once you exercise them, once you exercise the shares, when do you have to pay the 52%? Because probably quite a sizable amount of money.
It is. So you should be making that initial return to revenue within 30 days of exercise, and you should be paying tax over at that point. And after that, you're filing your income tax return the next year, but really that's an informational return at that point because you've already paid the tax, or you should have already paid the tax over to revenue.
And even if you haven't sold the shares, so you don't actually have the cash, but you still have the amount you need to pay to revenue.
Yes, correct. So I suppose what you'd see quite often with RSUs is that it'll be on what will happen is, let's say if you have an entitlement to 100 shares under an RSU scheme, quite often what will happen is that your employer will sell enough to pay the tax. So they'd sell 52 of those 100 shares, for example, and pay the tax over to revenue. So I suppose with stock options, you either have to come up with the money another way, or perhaps sell some of the shares to clear the tax liability.
Okay, so that's answered one of the questions. Thanks for that question, Kenny. The question here from Miroslav, do you have to complete a tax return as well as a CGT return?
I suppose it depends. So if it's RSUs, no, you don't. You're just completing a capital gains tax return because the initial taxing on receipt of the shares is all dealt with through the payroll system. If it's a share option scheme, then yes, you're obliged to file a full income tax return. Now, if you dispose of them in the same year, you can put it all into one return. So if you let's say you exercised your share options in 2021 and you subsequently sold them more or less immediately, you can put everything into one tax return if it all happens in the 1 year.
Okay, so with the RSUs, you get when they're vested, it's normally paid by income tax through your employer, like an employer tax. But then when you sell them on the other side in 2 or 3 years after, and you have a capital gain to pay then. So at that point, you're just paying capital gains tax. You're just doing a CGT filing. You don't have to do a tax return as well at the end of that year. Or do you have to do both?
No, if it was RSUs, you would just be filing a capital gains tax return. The receipt of the shares, that's all, as you said, that's all dealt with through the payroll system. It's the employer's obligation to deal with all of the filings and deduct the tax there. So it is only on the sale of the shares that the employee would then have an obligation to make a return to revenue and pay the tax over to revenue if there's any tax to pay on it. Okay,
we've one here from Andrew. I have a double trigger RSUs which don't fully vest until IPO. Is there any kind of reporting / anything else I need to do before then on the RSUs I am building up before IPO?
So I suppose without knowing the full details of the scheme, what I would say is if it's an RSU, then that pushes the obligation onto the employer to put it through payroll effectively. So I suppose until the RSUs vest, from a tax point of view, it's kind of like no taxable event has happened yet. So it would only be when they vest that a tax event occurs. And if it's an RSU, then the obligation is on the employer to operate payroll on it and deal with it. So in that scenario, then let's say they vest, the employer deals with the payroll obligations and deducts the tax, pays it over to revenue. It's then only on a subsequent sale of those shares that Andrew would have an obligation to make a filing with revenue.
Okay, if you have a follow-up on that, Andrew, feel free to put it in. If you need any more clarification. There's just another one here from Frank. I'm working in Ireland, but I was born and educated in the UK. Do I have options as my RSUs are held in a brokerage account in the US? So they're what we call a non-dom.
Yeah, in all likelihood, he's possibly non-dom. So I suppose non-dom is a non-domiciled individual. It's a different tax status. Effectively, it's someone who's I suppose there's a kind of a rough rule of thumb. It's someone who's from another country is kind of probably the best way of explaining it. It's not quite that. It's a bit more involved than that, but as a rough rule of thumb, that would be a good indicator. I suppose to go back and you take your two taxable events. The first is when you receive the shares, be it RSUs or stock options. There's no difference there if you're living and working in Ireland. The second taxable event is capital gains tax on the subsequent sale. So if you're holding those shares in, let's say it's a US multinational and it's held in a brokerage account in the US, and you sell those shares, if you don't remit those funds into Ireland, you're not taxable on that gain. So non-domiciled status in Ireland means that Ireland chooses not to tax your foreign source income and capital gains unless you bring the funds into Ireland. So for anyone who's not Irish domiciled, if they receive those RSUs, share options, and they vest and they exercise them and they get them, and they're held in a brokerage account elsewhere in the world, I would say think carefully before you bring the funds back into Ireland, because it will significantly affect the tax that you would have to pay on it.
And you could reinvest that. You could reinvest that funds and not pay tax on it either. So you can reinvest the funds that you're holding outside of Ireland. That could generate income, and that mightn't be taxable in Ireland either, potentially.
Correct. Yeah, exactly. You could effectively ring fence those funds and use it as an investment fund, and defer bringing that money into Ireland, or never bring it into Ireland, and you either defer or eliminate any Irish tax exposure on any income or gains from those funds then. Okay.
There's one here from Paulina. Is there a way to delay vesting of RSUs?
You'd have to read into the terms of the terms that the employer has put on the RSUs. But generally speaking, with RSUs, the difference is, I suppose, you go back to the 3 steps involved in a share option. You're given the option, all the conditions are met, which is your vesting, and you then have the option to either exercise it or not. And generally, there's a window through which you can either exercise or not. With the RSUs, generally speaking, the vesting, the conditions are met. Let's say it might be the company goes public, and once the company goes public, it's all conditions are met. Generally speaking, then the vesting tends to happen at that point. So the RSUs, I suppose, there's a little less control or a lot less control in the employee's hands around timing in most cases. Now, again, you'd need to read through the terms specific to the employer and see if there's anything in there that would allow you to defer. Okay,
we've got one from Liam here. From an RSU perspective, and the shares vest, does the employer allocate the entire amount of the RSUs and shares to the employee and then tax separately? Or is it the case that the vested shares are sold by the employer to pay tax on, e.g., 10,000 RSUs? Does the employee receive 10,000 worth of RSUs and stock and then pay 4,200 tax? Or does the employee receive 5,800 euros worth of stock?
It could be either. So generally speaking, what employers will do is they will maybe say to the employees, we have a scheme whereby you receive your RSUs net of tax. So we will sell enough of the shares to clear the tax liability. But it would generally be opt-in, is what I've seen, that the employer will say, we'll do this if you wish. The alternative is then that, depending on the level of the RSUs vesting and the value, that it's the tax is either taken out of your net salary for that month, or you potentially end up in a deficit position where you've got a negative net salary for that month, and maybe it's dealt with over a period of time, but it's generally an option to do one or the other.
Okay, there's one from Carla here. Will revenue really catch me? I can probably get away without paying tax on this. What do you think? It's worth asking, I suppose.
I would think, well, so first of all, if it's share options, the employer has to make a return every year detailing all of the people who've received share options, and they'll have your PPS number and everything there. I think it's an area with a lot of confusion, where people sometimes aren't sure of their obligation, who has to pay, when does that have to be paid, who does what, the employer versus the employee. So I would think it's an area that revenue could focus on increasingly, because you've so many companies located in Ireland now where either RSUs or share options are a significant part of people's package. So personally, if it was me, I have to say this, but I believe it too, I wouldn't take the chance. I would just deal with it and move on, because if you don't deal with it, if it's stock options and you don't deal with it, and it's up to you to pay the tax, if revenue comes along in 3 or 4, 5, 6 years time, and they say you believe you owe us tax on stock options you didn't deal with, you could be paying them double what you should have paid initially, so it's probably better just to deal with it, pay the tax and move on.
And fines and penalties can double the like, if you had to pay 50 grand in tax when you should have paid it, if you don't, a few years down the road, you could be paying 50 plus 50 in fines and penalties.
You could very easily, yeah. I mean, the interest ones at kind of 10-12% a year, and then the penalties can vary anything from 3% up to 100%. And
if your company that's giving you the stock options or the RSUs, they have to tell revenue all the stock options and RSUs that they gave on a yearly basis with the PPS number associated towards them. So they have it in their system. It's just a matter of them going looking. Like, they could easily be, squaring that off themselves on a yearly basis, couldn't they?
They could. I mean, but what the employer is obliged to do is they're obliged to provide a list to revenue the start of the following year. So in early 2022, they've got to send in a list to revenue saying, here's the details of all the share options exercised in 2021 in our company, and the details of the people involved. So yeah, it would be easy pickings for revenue. I would have thought very easy for them to cross check. So
there's no hiding.
No.
So just if we've no more questions, we usually wrap this up about 20 minutes. Just for people to know, when the email with the link to the video, and for us to be able to book a meeting with us if we want, the services we're typically providing here is where we're helping calculate what the tax liability is for the individual, because it is your responsibility as an individual to do this, make these tax returns. So we can calculate the liability, file the return for you, and then basically we'll do everything but pay the actual tax for you. So we're talking to a lot of people at the moment who are confused by it, because even though we know it very well, it can tend to be a little bit confusing. So we have a very clean solution where we can do all the hard work for you and just give you the option to pay the tax to revenue, and you'll be paying a lot of tax, but you'll be compliant. And I think that's a good place to be. So I think we'll wrap it there, as if you no more questions. So thanks again for your time. Very good a turnout as ever. Thanks, David, and we look forward to speaking to you in the future. Thanks, guys.